Welcome back. Earlier today, it was reported the Case-Shiller Home Price Index is beginning to cool. This is on Yahoo Finance. S&P CoreLogic Case-Shiller Index upward trend decelerates in November. The latest results from the Case-Shiller Index, it's a leading measure of home prices. The data released today for November of 2023 show that 12 out of the 20 major markets reported month-over-month decreases. Now we see here the red bars represent the Case-Shiller Home Price Index on a month-over-month basis. Green bars is the 20-city home price index, and it's up 0.2 and 0.1% respectively. But these are the smallest gains we've seen going back about a year now to January, February of last year. Same chart on a year-over-year basis. This continues to rise on an annual basis, but the monthly changes do show us the micro as opposed to the macro. On a year-over-year basis, up 5.2% for the home price index, 20-city home price index up 5.4%. Now we break it down in terms of the different neighborhoods. And we can see in particular the strongest markets include Los Angeles, San Diego, Miami. The weakest markets include Chicago, Detroit, and Cleveland. On a month-over-month basis, these are the strongest changes, meaning the biggest improvements since last month. Miami, Cleveland, and Las Vegas. And then these are the biggest declines. San Francisco, Denver, Seattle. On a year-over-year basis, it's a little bit more telling. The strongest markets include, or the biggest changes since this time last year, includes Los Angeles, San Diego, Chicago, New York, Detroit, Miami, Cleveland, Atlanta, and Charlotte. The weakest markets over the past year have included San Francisco, Denver, Seattle, Portland, Dallas, and Las Vegas. So there certainly is a divergence. It's not like real estate is the same across the country. There is certainly a divergence between the strong and weak markets, to say the least. Now, we have a Federal Reserve meeting on Wednesday. So far, we have a 46% chance that the Federal Reserve will cut rates in the March meeting. There's virtually no chance the Federal Reserve is going to cut rates on Wednesday for the January meeting. But notice the white line, the S&P 500 is moving in opposite directions to the probabilities of a Fed cut. The less of a chance that there's a Fed cut, the stronger the markets are. Well, that doesn't make sense. Usually stock markets like lower interest rates. Shouldn't it be the opposite? Shouldn't it be that the stock market goes up if there's a better chance that the Fed's going to cut rates? This shows us the opposite. But what's happening here, and we can see the red line shows us the probabilities that the Federal Reserve will not cut rates. Green line that they will cut rates. And this all changed as of January 19th. We spoke about this a couple days ago. That's when we had a number of Federal Reserve speakers who basically said, okay, we're going to cut rates this year, but we're going slowly. There's no need to rush. The economy is strong. And since then, since those speeches, we have seen a number of good pieces of news, including that 3.3% GDP that we spoke about the other day. So now the stock market is responding to the prospect of a strong economy. That's overriding the need or the desire for lower interest rates. In fact, the fact that the Federal Reserve is pulling away from the idea of lower rates is encouraging stock traders and stock investors to get into the market. They're saying, hey, look how strong the economy is. The Fed doesn't even, it's not concerned about cutting rates. Well, like we said, we have a 40 some odd percent chance they'll cut rates in March, literally zero on Wednesday. What do you think, though? Please vote in our poll. You go to our the YouTube page, click on community, and you'll see the poll there. What do you think the Federal Reserve should do? Should they cut rates in March by a quarter point, by half a point? Should they not cut interest rates at all? Or should they cut in a quarter in March and another quarter in May? We hope this has been helpful. We look forward to seeing you back soon.